Hey, what's up, y'all? Welcome to the stream. I hope you guys are having a good start to your Easter weekend, preferably with a beer in your left hand or an alcoholic beverage would suffice. Preferably left hand, I say, because I hope you're using your right hand to click on the follow button. Anyways, yeah, I got beer firmly welded in my left hand. I do have to work this weekend, so I can't go nuts, but I will be collecting that fat OT. But anyways, I hope everybody's making the most out of this shitty situation and having a good Easter dinner, making a turkey or maybe even a ham if you wanted to be crazy, and and enjoying that as well as, like I said, a few alcoholic beverages. So yeah, uh, start this off. We'll just do the old disclaimer. I am not a financial analyst. I am not a certified financial planner or a fund manager or any of that shit. I am not a professional. I hold no professional designations. Everything said on this stream is not to be taken as stock advice, and I am not responsible for any losses you incur by following my opinions because they are simply opinions. So if you need professional advice, seek a professional. Don't seek me. Anyways, okay, let's analyze some fucking stocks. Okay, so this week I had said I was gonna do a stream yesterday, and I when I said that I kind of fucked up and forgot that it was only a 4 day work week. So and that being a 4 day market week, tomorrow is the market is shut. So I figured, hey, we'll just postpone it one day because I don't want to just do a recap on Wednesday and then one more day do a recap of just one day. So kind of wanted to go over the whole action of the whole week. So yeah, just figured we'll dive into that and then do some analysis to cover the whole 4 days. So yeah, SPY today kind of was an interesting end to the day, or even just an interesting day overall. The market was looking good, and I'm talking about the S&P 500, so the broad American market right here, this index. It was looking good. We broke out of this wedge, and then kind of back tested it, and then ended up going above resistance here. And this is just the hourly chart. And in a previous video, I'd said I caught the bottom here when we started to see the indicators diverging. So this is what we call positive divergence. So you're starting to see the indicators rising while the price is still declining. So that means it's kind of gathering strength and attempting to find a bottom, which it did right here, and then proceeded to gap up and has been kind of riding up ever since. It did a back test to hit this bottom here to make a new trend line, and then rose out of this wedge, like I said, and ended up we ended up here. And so today kind of gapped up uh, on good news. Well, good news depending on who you talk to, but that the Federal Reserve is going to be buying high yield junk bonds through ETFs. So essentially, the Federal Reserve, which it is supposedly not uh, legally authorized to do, is buying exchange traded funds, so equities on the markets, and that is JNK and probably I think HYG is the other one. So they're basically they track high yield junk debt for corporations. So when corporations can't get financing through like really secure means, they have to go for these high yielding bonds because the bank figures that they're more risky, so they want a higher rate of return. They want to charge a higher interest rate to the company, and that's where these corporations have to buy this shit debt, which they call junk, and it's obviously costs a lot more money for the corporation and is more risky. So that was kind of what was driving the market to gap up at the open right here, and then we kind of had a really flat day until we got this big drop at the end, and it recovered a little bit, but not too much. So it was, and that's kind of coinciding with some negative divergence now. So you hit this peak on the RSI, and this peak ended up being lower on a reading. So maybe we'll get a third one lower. I'm not sure. Maybe we'll retest this line and end up rising higher before we get a lower one. We'll have to see on Monday. But it was, yeah, just kind of a really interesting close. The whole broad market just kind of gave me an icky feeling. So yeah, I'm positioned really defensively now, and I'm just not sure exactly what's going to happen next week when the market opens, and especially when we have a 3-day weekend to kind of mull over things and let the politicians pull their strings and do whatever they're doing. Okay, so yeah, you look at here the daily chart. Um, had choppy action. We ended up hitting this green line, the Bollinger Band, which kind of coincided with that dip, and then so we ended up with a doji candle here at the top, which is a sign of indecision in the market. So again, that's gonna have to play out. We'll see what happens on Monday, but seeing that candle is not exactly a good sign. Sometimes the market can shrug them off, but oftentimes it's a sign of reversal, which is like you see up here, but you get a couple of them up here, and just not a good sign. So that's so this is the weekly, and then you can see it also coincided with hitting this 100-day moving average and ended up bouncing off of that. So there's another kind of potential resistance zone to be noteworthy of. And one thing I had noticed, I was kind of looking around on the charts and poking around last night, and I kind of was comparing the action between this recovery and let's go back a little further to the 2018 recovery, which looks very different in terms of volatility. I mean, you look at the candles here, really not a lot of gaps, and kind of like there's a large volume action, large swings initially, kind of tapered off, and you get like one more here, but overall the market just kind of slows down and ends up kind of resuming that upward crawl, which is usually that's a good sign, right? I mean, just things are moving back normally like they should. Whereas here, like it's all over the fucking place. I mean, we're bouncing around. It looks like it looks like a fucking squash match or something, and it's all over the place going around creating sloppy gaps, gapping up and short squeezing, and then you end up with that doji. That's the icing, or kind of the cherry on the cake. And it just didn't. This didn't look anything like this. And so I started even going back a little further. I figured, hey, fuck it, let's go back to 2008 and look at what 2008 looks like, because that kind of is more similar a financial crisis situation to now than 2018 was. So go back and you kind of compare the two. Let's even zoom back in on that, get the more clear picture. And I mean, you look at this choppy action and compare it to right here in 2018 when we hit near-term bottom in October. You kind of flirted with it here, hit it more solidly here, and then had a bounce up. Was a little bit more short-lived than the one we're having now, but ended up creating a new low and then yet another new low in March. So, I mean, months later, like 4 months later, it bottomed. So, I don't necessarily think we're out of the woods here yet. And that's kind of what's having me remain defensive. I think, if it gets rejected here in this no man's land here, and especially, like I said, at the 100-day moving average for here, maybe we could see it go retest this trend line again, or possibly even go lower. Who knows, right? I mean, all kind of bets are off. I'm not making any assumptions in this market right now, and it's just good to remain open to possibilities. And I could see it hitting here, maybe retesting this support line around 227, and if not, eventually hitting 195. But I can't see that being another waterfall like we had here. I'd feel like it would be more of a bounce, just like it was in 2008, really. So you had the kind of the waterfall bounce, somewhat of a recovery, and then that was the bear market rally back down, and then we're just kind of doing a little bit of ping pong back and forth until we finally found the low in March. So yeah, I mean, this could play out until the summertime. Maybe we won't see the low till the summertime, or maybe even fall. Who knows, right? So again, like I'm remaining defensive. I'm highly cash in my portfolio, and I even bought a little bit of a inverse ETF that basically bets on the TSX market going down. So I'll show you that here. We'll cover the TSX. So that kind of had the same sort of bounce back, hit our support, and we've closed below that support. So that's interesting to see. Um, Zoom in the daily, kind of same thing. A little bit less of a pronounced of a doji, but still kind of there. And another indecision sign. Maybe this MACD looks like it's going to start trending down again. So I'll have to watch that. We are in the above the sell zone for the RSI, and we're in the bullish zone. So that's kind of good. It's a better sign. And same, we're up here with the slow stochastics as well. So that's a good sign as well. If we're here, that's rally mode. How long we stay there, I don't know. We'll see. I mean, you could end up being in there for a month sometimes, or then sometimes you end up being in there for only a couple days and you're back down. So we just gotta have to keep an eye on that. But yeah, again, my inverse position that bets on this market going down is more of a hedge at this point. It's really tiny. I'm not betting on being a bear. I usually don't play the short side. I don't typically like it. I think you lose more than you win. But yeah, it's good to be hedged, I think. And one reason I kind of came to this conclusion, another reason is because I've talked about this before. I think lumber is a mucho importante indicator, so I usually like to follow it. I think from what I see, the correlation is that lumber in normal times usually leads the market by about 3 to 4 months, or 3 to 6 months. Sorry, 4 to 6 months. Yeah, I'll eventually get my numbers right. I'm not dyslexic, I promise. So 4 to 6 months usually has a leading effect on the market. So you'll see rises in lumber before the market will rise, and dips, etc., except in times of mass volatility like we've had lately. And lumber is the candles here, and this black line is the S&P 500. So you typically have them kind of move in tandem during deflationary times, or corrections, stuff like that. So because everything is going to get sold off at once in the broad market. And so here, to me, it looks like lumber, and these aren't to scale, so don't think it has to track the price exactly. We're just more looking for what would you put it? Just the same kind of movements. So we had lumber come down here, bottomed in mid-March, which the market continued a little bit lower until the 23rd, and then we had lumber pull a little bit of a recovery and got rejected here, ended up kind of trading sideways a little bit, and then dropped and made a new low in April. So this is kind of where I think that maybe lumber has gone back to being a forward-looking indicator, and now that we've had this precursory drop, maybe that's forecasting a newer low in the market. And given what we've seen today, maybe that could be in the cards for the next couple of weeks. So after it did bottom and made a new low, it has gone back up pretty strong since. So that's a good sign. It's been up. I think these are both 7% days up. So that's a really good sign. So maybe when we hit new bottom, or maybe even retest the lows in the stock market, maybe we'll get a higher high. We'll see. And then so copper is another really important one I follow for an economic indicator. That kind of it's kind of wedged in this no man's land here. Bounced off this trend line and closed about midway from where it rallied for the week. The daily kind of looks a little bit weaker. This could be considered a flag. So if this is flagging, and it truly is a flag, and it kind of looks like it's almost ready to turn here, and the MACD is going to continue lower, and we're still in the sell zone here, so that completes that flag. We could see lower prices, and I'm thinking if we're seeing lower prices in the leading indicator in lumber and lower prices in copper, I would expect the market to go lower, and it's kind of going to have a deflationary effect as well. So we're kind of like deflationary round two in the market. Gold kind of. I haven't really tracked gold much on these live streams, but I post about it quite a bit in my StockTwits account. I've kind of thought it was going to flag a little bit, which. Here, hang on a sec. Let's duplicate that and let's go gold weekly. And this is kind of what I thought was going to happen, and it did end up almost playing out like that. So it held at this resistance line and had popped up before, but then was was kind of knocked back and was holding right here, and it looked like my pattern was going to come true, and it ended up breaking out here and closed up for the week. But big hairy but. So this is GLD, which tracks the gold, because I can't pull up gold and hourly on stock charts. It's kind of stupid, but from what I see here, negative divergence here as well. I mean, this might make a new peak here. Whether it gets above this line or above this peak remains to be seen. But again, we're seeing it same thing as the MACD, and you guys know I love the negative divergence. That is one of my favorite indicators. I live by it like the Bible. I don't live by the Bible, but that's one of my holy grail indicators. I use it a lot, and it usually never turns out to be wrong. So I'm kind of seeing that happening here, which tells me that gold market's getting a little bit weaker, and eventually will take a dip. And I kind of expect it to still play out like this. And maybe next week we'll end up with a shoot up and then a long wick candle that brings us back down to this channel. And I kind of figure I'm going to at least target this red moving average. So let's say 1350, something like that. Maybe we end up around here, and kind of that would be as far as I think gold will go. But you never know. I mean, in 2008, when everything was kind of all effed up, gold ended up selling off, I think 36% in off the top of my head, I want to say it's like 6 months or something like that. So there is definitely kind of reason to believe that gold might correct back. I'm still long-term bullish on gold. I mean, with all the bajillions of money that they're bazooking the economy at like record levels, it's only a matter of time before gold starts taking off to the fucking moon, because of all the inflation that's going to kick up and the lack of stable currency in the world as the US dollar begins to sell off, because it's going to be absolutely worthless. So I'm also kind of playing that on the short side a little bit, but maybe if I'm wrong and it keeps on going up, I'll stop out and then I'll take a loss on that trade, but no biggie. So oil was kind of looking promising last week. I had made a good play on it, made some good cash trading a leverage ETF on it. So ended up selling that. I'm glad I did, because it did not do very well this week. So we had an open, kind of took off during the beginning of the week, I should say right here, and then ended up kind of just fading back. And then, so this was all in anticipation of this OPEC meeting, and it kind of really turned out to be a buy the rumor, sell the fact type scenario. And you see that in a lot of things when Donald Trump talks. And I mean, it was the same kind of thing as he was doing with those China deals about a year ago, where he'd get up on the podium and he'd go, "Yeah, soon we will have a deal with China. It'll be the most tremendous deal ever. It'll be a great deal, the best deal we've ever made. China's going to start buying our agriculture, millions and millions of tons of agriculture they promised." And he'd say all this stuff, and then like next week, China to be like, no, we didn't say that. No, nobody's buying anything. I don't know what you're talking about. And so it was his way of kind of like coaxing the market into believing what he's picking up what he's laying down, and keeping them kind of on the line. Is you kind of keep you never want to let the deal look sour, so it's like you kind of keep that positive tone into the deal, and the market bought it a lot, and kind of shrugged off the China news. But then as soon as I would have to look it up to see which day it was exactly, but there was I remember one specific day where he'd been talking up the deal the whole time, and then I think it was China wasn't doing anything, so he just slapped him with tariffs, and then the market just took off, and like it ended up like kind of nosediving for a period, and I don't think it sustained, but yeah, it sure went the wrong way. So it was kind of like a buy the rumor, sell the fact. Oh no, sorry, he didn't slap him with tariffs. He announced that there was some sort of deal, that there's a pause on tariffs, and so that looked like there was a deal, and then that's how, and then the market ended up selling off instead. So it kind of like it already priced it in, and it was just like, nah, we're done, and it took a nosedive. So that's kind of what happened with oil here today. We got it right first thing in the morning. that the Saudis and Russia, well, OPEC in general, was taking a 10 million barrel a day output cut for 2 months. And, as soon as it said that, it kind of just started selling off, and it went pretty damn hard and right until the end of the day. So really down day, formed this bearish engulfing candle, which is not very nice candle. And I mean, you look at the MACD and it looks like it's about to turn and go lower. And from what we've seen before, I mean, you look in 2014, and if this MACD stays for as low as it is, it can stay for low as it is for a long period of time. So that is also something to watch. And we've kind of turned as far as the RSI zone goes. So we're going to have some more time dwelling in this oversold zone. Maybe we'll even get way oversold like we did before. I mean, look at here; it kind of peaked up in 2014 and then carried on, business as usual, dropping. So yeah, I mean, you can kind of see that daily too. It's set to go back in there here too. The stochastic RSI is also about to drop into the sell zone, so it doesn't look very good to me. And that's where I kind of wanted to examine like the wording of this deal. And I'm like totally doing air quotes. You can't see, but air quotes deal is, well, for one thing, it's all on words. Nothing's written in stone. So all they've done is promise to cut 10 million barrels a day out of its oil output for 2 months. And I haven't looked into this really a lot further about which country is taking what amount of cut. Are they dividing in half, or is Saudi taking more of the cut than Russia is, or what the fuck's going on there? How are they going to hash that out? And so, and you look at the language of it. I mean, for 2 months, so that's not enough, considering that we're estimating that demand loss of 35 million barrels a day, and you're only cutting not even a third out of that. So that's not enough to stop the glut from building. So storage levels are still rising. I know for certain that plants in Canada are shutting in, and I've heard that as the same thing in the States, because there's just nowhere to put anything. They're running out of storage. So if you have full capacity, yet people are still pumping, and we saw this in 2014, maybe they're going to start fucking filling up tankers again. And they were doing that. They were filling up super tankers and parking them offshore just so they had somewhere to put all this extra oil. So there could be a lot more supply coming in into a market that is just shrinking with demand. There's no demand. There's nobody to soak up this oil. So we know from the basics of supply demand, if there's too much supply, not enough demand, prices have to fall. And that's what we're looking at more here. So that's another reason why I think maybe this will have a drag effect on the market, because I mean, you're going to have a sector that's going to start collapsing pretty hard again. So, and maybe we'll end up going below 20 this time. Maybe we'll end up going to like my nightmare scenario, which was 10, which would fucking suck. Especially for me, because I'm employed in oil and gas. So hopefully that doesn't happen. But at least you guys would be seeing a lot more of me if it did. I'd have a lot more time to dedicate to this shit. But anyway, another one thing I wanted to point out too is that so Saudi Arabia and Russia both agreed to cut output to about 8.5 million barrels a day. So I'd have to look. I think Saudi's at 10. And again, I don't know what the combination is to make this. So Saudi's pumping 9.7. So what are they going to, like 4.5? Who knows, right? But what was I going to say there? So there was a kind of a clause that Putin had put in there. Okay, so yeah, right here. The Kremlin had insisted that America must do more than just let market forces reduce its own record production. And U.S. President Donald Trump, meanwhile, has said his country's cut will happen automatically as low prices put the shale patch in dire straits. So he's meaning the free market is going to cut production based on what I said earlier, which is like, now we're running out of storage. There's nowhere to put it, so they have to stop producing. And so you're going to see companies naturally start to shut down production, and that will, over time, whenever demand starts picking back up, that will start to drain the market of this glut. and get prices moving back upwards, back into normal territory, or where it should be. But I mean, then again, like even if we start demand back up, which is probably going to start up slowly, it's not going to be we just get everybody back on the streets in their cars immediately, and all the airplanes flying. I think this is going to take quite a while. Like I, I don't know if they're saying like we're a year out to a vaccine. Like maybe by the time you get everything up to full capacity, and that's assuming that things are still the same economically, which I don't think they will be. Um, we're looking at, I don't know, 2 to 3 years before you kind of get oil back on track. So that takes a long time to reduce that glut, because you have to first drain the excess uh, um, oil out there that's already sitting in storage. Like I said, in the tankers and all this shit, just piling up. So you gotta remove the pile first before you can bring the production back on, and then you have to do that slowly, because obviously you're still running at such I guess fine line of storage capacity. So it's going to take a long time for this to play out. So yeah, it doesn't make me feel good about the way oil prices were going. And again, getting back to what I was saying here, now that Russia and Putin in general has insisted that the U.S. has to force their companies to cut production and not just rely on the market to do it, that's giving them a way out of this deal. So, you know, Putin's a slippery devil. He's a sly dog. He's always got some kind of, something in his pocket that he can pull out and be like, nah, this is my chip. I'm throwing this one in, and he'll mess you up. Like he's a master maneuverer politically, and I think this is giving him an out where he can say later when it suits him that no, Trump, you didn't cut anything. It's all us doing the cuts. Well, F you, buddy. We're gonna start our production back up and really collapse the oil price even more. And we must not forget that the stated aim of this, right from the get go, was to increase market share. And they say it's a price war between Saudi Arabia and Russia. I think it's kind of a case of the enemy of my enemy is my friend. So being Saudi Arabia and Russia, they can look at each other and go, okay, well, let's start this war, increase production, and we'll collapse the U.S. shale sector. And at the end of that, when all those companies are bankrupt, hey, guess what? Somebody's got to buy their oil from us. And obviously, in the Canadian sector is going to get hit really hard, which is also a major producer, and they're going to come out of this laughing. Maybe that's a definite maybe. This is still a bet, and maybe it won't pay off for them, but yeah, that's their plan. And do you think they're just going to give that up overnight? Nope. I mean, they started this plan in the midst of the coronavirus outbreaks, so I believe that they're factoring that into their plans, and they know they have an opportunity to strike while the iron is hot, and they're going to hammer it right to Donald Trump and hammer it right to the U.S. oil patch and their dreams of energy independence. So yeah, I kind of look at all that, formulate a picture of like how that's all going to play out geopolitically, and I don't see a good way of oil prices getting out of this anytime soon and recovering. So likely this was a sucker bounce, what they call even a dead cat bounce, and we're going to continue lower to the nightmare scenario of $10 a barrel, which, for Canadian energy in particular, paints a really ugly picture. We're so. Oh, I went to the wrong one. So if we look in the TSX index for Canadian energy, again, we had rebounded a little bit on higher oil prices, even just the stock market recovery in general. And, today we kind of hit this peak, and you're seeing some hard resistance right here. And it doesn't look like it really wants to pass that. So I think we're kind of going to be on the down slope and maybe even continue lower. So likely you're going to see some bankrupt companies. And one of them I had looked at today, interestingly enough, was Suncor. And Suncor was forced to buy or issue debt at a higher rate now. So, like I was talking about earlier with the high yield debt, because there's more risk out there in the market, and especially the oil market, like we see with what's going on with prices. Obviously, if companies aren't making as much for their product, they're in more dire financial straits. So banks know that, and they're not going to want to lend to them for the same low rates that they have been. So that's where we're seeing interest rates come up even on corporate debt. And Suncor just had to issue debt on double the rate that they had last year. So last year they issued it below 3%, and this year just recently was above 5%. So that's a huge jump. That's a huge jump for interest rates in 1 year. I mean, think of how low they've been for how long, and all of a sudden they double. You know, probably really in short of or in the span of a month, because I imagine before this whole coronavirus crisis they were probably still very low. So we're seeing banks wanting a large price for their loaning their money, and that's going to have a negative effect on the companies, because that's obviously a bigger debt load to Suncor and a bigger interest payment to Suncor. So that kind of even saps their finances a little more. And if they're going to need to keep on issuing debt in order to finance their operations, yeah, that's a big problem. I mean, you could see big fire sales on assets, stuff like that. It might be divesting from things. They've already slapped or slashed their capex budgets for this year and next year. So I mean, they're really trimming the belt and or tightening the belt rather, and bearing down for the storm, battening down the hatches. So yeah, gonna see a little bit of a weight on the energy sector. So I'm not touching energy for now. Um, but one thing I had not mentioned when I talked about the market and where it could possibly be going. Oh, I want the weekly. That's what I want. So, say if we end up taking a dip here, and then we ended up double bottoming out here. Me personally, I would. I have bought a little bit of stuff. I've bought commodities kind of down at this level, and the S&P 500 via a TSX traded ETF. Um, so I mean that's a lot of acronyms. Sorry about that. Uh, but I'm buying it through a fund that is traded on the Canadian market, so it's denominated in Canadian dollars, but it tracks the S&P 500, which is this guy right here. So if it gets to that level, I'll probably add a little bit more. If it gets to this level, I will definitely that'll be the point that I probably start to load up. I won't, throw the kitchen sink at it, I don't think, but it would be a smart idea to buy it down there a little bit more as well. And that's kind of my whole strategy in this is when I buy at these levels to keep buying on the way up as I see things improve. So, and they say buy low, sell high, but I mean at the same time too, you have to protect your capital from not being down a long time. And I had this conversation with some guys at work today how you don't want it to be sitting on a loss. I mean, if you would have bought up here, who knows how long you're going to be sitting on a loss for? And I had compared this on StockTwits too in a few days ago about how in 1929, if you had bought at the peak right before the big stock market crash of 1929, which is the most probably famous one of the last century, um, if you had bought that at the peak of that market, you would have been sitting in the red till 1954, I believe it was. So, you still would have gained your money back in the long run, but that is 25 years of sitting with your money just stagnating and at a loss with less money, whereas you could have put it somewhere else and had it be more productive to you. So that's what I tried to avoid, and that's called your marginal cost. So I I try to keep my marginal cost as low as possible, and that's where risk mitigation comes in. So if I buy on the way up, and I'll be very fucking clear about this, if this keeps on going up and we get into a new bull market, that will not be the end of higher returns in the stock market. I mean, it's going to keep on going. If we can somehow miraculously shrug off this economic catastrophe and this pandemic, and the stock market can keep rocketing higher, it's going a lot higher. And there would be no reason to believe that it wouldn't. So I mean, I don't know. That would blow my fucking mind if that happened. Maybe I would just throw the towel in. I don't know. But no, I wouldn't. But on the way up, I would be buying because I know, once I see it go like above here, I'm like, yeah, we're out of the woods. Hunting season's over. You can all come out now and wander the forest. Like buy at will. You're good to go. So that's the kind of way I'm looking at it, and that's my plan for this market. So I'll leave it there. Anyways, I hope everybody has a great weekend, great Easter weekend. Hopefully, you can maybe, I don't know, get on Skype with your family if you're kind of by yourself, or like just do something chill, have a good dinner, crush a few cervezas, and most of all, for all you Bible thumpers, just stay out of church and pray at home. Have God can be in your home too, and you can do your praying in there. Stay away from large gatherings and shit like that. Don't get sick. Anyways, guys, stay healthy, stay safe, protect your profits, and I'll catch you all next week. Peace.